what is an investor to do as you sit here on this investment committee?
I think what we're doing and what I think investors should do is continue to think about what we're looking at in the second half of next year. And the fact that, to Joe's point, the economy is strong enough right now. Even if we print a sub 2% GDP print in the second half of the year, where is the alternative for you as an investor in the second half of the year, and where do you feel most confident? It's obviously not going to be in the bond market. You're not getting paid. You're not getting paid to go out any further than 2.5 years on the yield curve. You're not necessarily getting paid outside of the United States, despite the fact that valuations are attractive, and I think we're going to talk about that a little bit later, hopefully. But I do think that from an investment perspective, that quality bias that we're seeing in the names that are being bought up today, I think that's going to continue to be consistent. I think that in a slow growth environment, which is what we're facing in the back half of the year, I think that you want to own quality companies that have a competitive advantage. And I think you want to own stocks.
I'm sorry, forgive me for stepping on the end of that. Earnings good enough, Liz, to take the market higher?
I want to go back to a point that Joe made. I don't know that this is the same market that we had before the cut, because before the cut, this market was up 20% because we were expecting cuts and we were expecting a lot of support from the Fed. So now the market has to transition. I agree that we can still go up from here. I don't think we're going to see another 20% for the rest of the year, but we can still grind higher. Maybe 5% is reasonable, but we need to do it on the back of something else. Earnings are mixed. I don't know that they're strong. Average earnings growth is
better than it thought. We can say that, right?
But I think we expect that. We expect us to always be better than we estimated. So that doesn't even really garner much of a reaction anymore. Average earnings growth is 6 to 6.25%, and we're expecting full year 2019 to be about 2.6%. So that's below average. I wouldn't say that there's a strong momentum in earnings to really drive us through. We are expecting the back half of the year to be stronger than the first half, so that's positive. But we need the market to pay more attention to economic fundamentals and not so much to monetary policy.
Right, Joe, Liz makes good points. I mean, the market ran up on anticipation of, you've got to believe, more than 25 basis points of a cut. So if it's not going to get the full at least 3, the market had priced in 3, then what do you have? What's the justification for stocks being then where they are? If they got here on the premise of 3 cuts, right? If you're only going to get 1 cut, don't we need to rethink where we are?
That's making the assumption that we got here on the premise of 3 cuts alone, and that.
Well, we got here on the premise of Fed's coming to the rescue. They showed up yesterday, they gave you an ice cream cone, and they left.
Well, we got the pivot in January and the communication from the chairman. I think that's what reversed where we were, the negativity in December. In the last couple of months and even in the last 30 days or so, I don't see that it's the anticipation of 3 cuts why stocks are rallying. I see it as earnings from Starbucks, earnings from Apple, earnings that are telling a story that is not as apocalyptic as what I heard 6 months ago.
You know, I would say that, well, first of all, we never know why the market is where it is, right? We can all make these conjectures. Everybody pointing to a different set of facts or different charts.
But you got to believe that the Fed anticipation played a huge role.
Right. And I do believe you have to pay attention to monetary policy. We saw that in December, then we saw it in January. For me, it's the fact the Fed is not embarking on a rate tightening cycle. Rates are historically low. I don't think anybody invested in the market a year ago because they perceived the Fed was going to go 3 times. So they kept going in. Now, true, the market's relatively flat
Fed's
since
like
a
an
year
addict.
ago.
The Fed's addicted to cheap money.
Right.
The more you
Everybody
give it,
is.
the more it likes it, whether it needs it or not. If you're going to feed it.
True, but we have cheap money. We have rates that have been historically low for an historically long period of time. Nobody's complaining about a lack of capital or a lack of available funds. They're there. What would damage the market is not if the Fed doesn't cut, because you don't want to see finality. If we got 3 cuts right now, say we got 75 bips, market would trade up a little bit, then it would trade down because there's no more to come. So I think the fact that we haven't done everything and that we're not tightening is enough to keep the market going. Because that's what kills markets, tightening.
All right.